In this video, we are going to go through cash value life insurance, really whole life insurance, the core benefits to the product, how to set it up for maximum cash value, and then how to use it, whether that be using it as a financing tool or perhaps for retirement income. Now, when it comes to whole life insurance, right, cash value life insurance, when you hear that word, typically what comes to mind? While most individuals, we'll call it the herd mentality, have heard or believe this, that it is a bad product, expensive, has weak returns, the cash value will barely grow at all. You're much better off purchasing term insurance and investing the rest. If you get a whole life insurance policy, there is a good chance you're going to have buyer's remorse. Have you heard that before? Perhaps we've heard something very similar from that of Dave Ramsey or Susie Orman, who are very big proponents of buying term insurance and investing the rest. But then you've got the 1%. The 1% have used whole life insurance, cash value life insurance forever and put as much money as possible into these products. What's interesting, so up here you see banks, corporations, and wealthy individuals. If you were to look at banks, some of the largest banks, Bank of America, Wells Fargo, Bank of America, for example, has north of $22 billion in the cash value holdings of their life insurance policies. The death benefits are much larger than that. So the question we always get here, because wealthy individuals utilize cash value life insurance for the cash value, but also legacy planning, is why? Why does the herd mentality promote whole life insurance as a horrible place to put any money? And then you see the 1%, the ultra wealthy, call it the people that have it all figured out, put as much money as possible there. Well, some bullet points here. What I'll add first and foremost is that it often has to do with the cash value. That is a huge driver of interest. So a couple bullet points here. When it comes to the cash value, you've got safe, liquid, tax-free, and always compounding. We're going to go into this in a bit more detail here. So when it comes to whole life insurance, I've got our little graph here. A couple things I want to mention is when we open a whole life insurance policy, first we have a premium. Now our premium is level for the life of the policy. Now naturally, when we hear the word whole life insurance, how long do we think that we have to pay into the product? Our whole life, right? The thing is, a policy can be designed, we're going to get into that a little bit here, we can design it in a manner where we can fund it for 2 years. Maybe it's 5 years. Maybe it's a certain age 65. Perhaps we stop and go and we can adjust our payments up and down. We can make it very flexible in that respect. We have a death benefit, and this is the case with any life insurance policy. Death benefit proceeds are always paid out 100% income tax-free. Now it's important to throw the word income tax-free in there. Life insurance proceeds are typically not exempt from estate taxes. If we have a high net worth and we're trying to leave a large legacy, typically we want to do some type of planning with a trust and work with an attorney on that. Now with a whole life insurance product, you will often see the death benefit will gradually accumulate over time. Then we've got the cash value. Here is the topic of interest. This gradually increases over time. And the thing is, it goes nowhere but up. Regardless of things going very, very well in the stock market and the economy, one will see their cash value continuously increasing, or if things are going very, very poorly in the stock market and economy, one will see their cash value continuously increase. So a couple bullet points here on the cash value component of a life insurance policy. So when it comes to the cash value, number one, no risk. And specifically what that means is that the cash value in a whole life insurance policy is not invested, tied to the stock market in any way, shape, or form. We are completely separate from the stock market. How the cash value grows, because that's often the question that comes up. Hey, if you're not putting any money, or if the insurance company is not investing any of my money into the stock market, how is it growing over time? Couple components. One, I have a guaranteed rate of 4%. which is often accompanied by a surplus. The guaranteed rate plus the surplus equates to a total dividend rate. You'll see with the top companies, some top companies out there today would be a Mass Mutual, a Guardian, a New York Life, or Northwestern Mutual, some of the larger carriers. You'll find dividends for 2020 range between 5 and 6%. As a quick example here we go. So we see a dividend year of 2020. We see a guaranteed cash value interest rate of 4%. Total dividend rate is 5.65%. What this means is that the company declared a surplus of 1.65%. The guarantee plus the surplus equates to the total dividend interest rate that company had paid for 2020. And you will find with those top companies, they've been in business for over 160 years and have paid dividends for over 150 years. And we can go as far down as we'd like here, get some history, which is always fun to look at. In the 80s, when interest rates were very, very high, you see very, very high dividend rates. You will find that dividends tend to fluctuate with the interest rate environment. Let's continue on here. Payments we make to a cash value life insurance policy are done so with after-tax dollars. So specifically what that means is that one cannot deduct payments made into a cash value life insurance policy. You can set it up within a qualified plan, but it often does not make sense. If you remember those core benefits, we had safe, liquid, and tax-free. If we deduct payments on a life insurance policy and it becomes a qualified plan, or we put it in a qualified plan, then we've got that unfavorable tax status. So payments, kind of like a Roth account, if we want to use that similarity there, after tax dollars, that's how we fund it. The growth is tax deferred. So as it grows, I do not have to pay any taxes when there's a gain on the product. And then I can access it tax-free. However, I always like to throw this word in here, if. If done so properly, we can access our money in a whole life insurance policy tax-free anytime we want. Why I throw the word if in there is if you've done any research on cash value life insurance, you may have seen that it is marketed tax-free, tax-free, tax-free. And it's exciting. Who doesn't want something tax-free? The thing is, there are instances that can occur where we can trigger a taxable event and our cash value will not be tax-free. So we want to be educated on that as a consumer, and as an agent, we want to make sure we're doing that for those we work with initially and indefinitely. And then we have a unique loan feature associated with the policy as well. And this has to do with actually using the money in a cash value life insurance policy. So we talked about the benefits of it. Here's several benefits of cash value life insurance: safe, liquid, tax-free. We're going to get more into the compounding and the loan feature there. But the next piece we're going to touch on is the design, or how to set it up. How do we set up a policy for maximum cash value and flexibility? Because if you've ever seen whole life insurance, many people have seen something that looks like this. This is very common here. So we see a traditional old school whole life insurance policy here with a 40-year-old male paying in $100,000 per year. And look at his cash value in the first year, $3,300. I pay in $100,000 and have nearly nothing to show for it. Like who wants that? I have a death benefit, but at age 40, I could also buy a term policy for next to nothing for that same amount of life insurance. Now, year 2, I pay in the same $100,000. Okay, I get it back. Picks up over time. However, it is not between years 10 and 11. It's really year 11 here, highlighted in yellow, where I break even. At that point, I've paid in $1 million over 10 years, nothing thereafter, and I have $1 million in cash value. That's a long time. This is a traditional policy. I'll often refer to this as a great example of what not to do. So let's go through how to design a policy for maximum cash value so we can turn what we just saw, which is this example, into this. Same product, same individual, same insurance company, redirecting where his money is going. And anyone can do this regardless if they're paying in $100,000 per year, $10,000 per year, or $1 million per year. Doesn't matter. It all has to do with how we set that policy up. Let's take a look here and go through some of the mechanics here. So, topic here, maximize cash value and flexibility, right? When we think insurance policy or insurance product, regardless if it's life insurance, auto insurance, whatever it might be, typically we have a premium where we pay that premium and we have a benefit. We don't have much flexibility as far as adding more money into premium, adjusting it up and down. So the question is here, when we've got this cash value benefit that so many people are attracted to once they understand it, how do we design it where it's flexible, where I don't have this bill that I feel like it's a burden. I got to pay the same amount every month, every year. What if things get tight? What if I want to do something else with my money on any given year? So when we pay any amount of money into a life insurance policy, here's the thing on this. We can choose where it goes. I can direct it toward the insurance premium or what is called a PUA rider. PUA stands for paid up additions. So I want to understand the relationship of these two areas. English translation here to make this simple. The premium I'll refer to as the initial insurance expense, and the PUA rider I'll refer to as a cash dump in. And you'll see why in a second here. So let's assume that I am going to pay in $1,000 per year into the premium piece. How do those dollars work? Well, the dollars that I direct towards the premium, in respect to your cash value, you will often see 0 show up in the first year, and often the first and second year. If you recall that traditional policy, it was just year 1 where he paid in $100,000 and had next to nothing. 3%, $3,300 of that 100K show up in cash value. Beginning year 2, it came back to cash value for him. So point here is when we hear the word premium, we often think expense, indefinite, I'm just buying an insurance benefit, which you are with that. However, once we hit the third year, second or third year, depends on the product, you will find that money comes back to work for me. So it does begin to capitalize the policy and I have access to my money. Now, why I have nothing right off the bat is really because the insurance company is going to overcharge me for the cost of insurance or death benefit up front. So with a whole life insurance policy, when I have nothing in the early years, typically the first 2 with most companies and products, the reason why is that the insurance company is overcharging me for the death benefit, the cost of insurance. Now, I've got the PUA component. If I pay the same $1,000 per year into this area, here's what your policy will look like. If I pay $1,000 in, I'll see right off the bat, just about $1,000 show up in cash value. This is money I have access to. This is money I start to see the guaranteed rate and any surplus, or call it total dividends, applied to. Now the term, again, stands for paid up additions, paid up additional life insurance. And what that means is, 1, this is optional, but when I make a payment into this component, shows up in cash value, it also purchases me some death benefit. For a 40-year-old male, like the example we just saw, on average, you may see if I pay in $1,000, $3,000 may come back to death benefit. It purchases me additional life insurance as well. However, the attractive component here is directing funds towards the PUA rider to accelerate the cash value growth. That's the area where everyone's interested. So a question we'll often get is, okay, Steve, thanks for going through that. Appreciate it. However, I don't care about the death benefit. So how do I put 0% of my payment here and everything else into PUAs, regardless of how much I'm paying in? So we can't go quite that aggressive. The reason why is we have to be aware of the different limits. Two limits. We have the insurance company limits, and then we also have the IRS limits. Let's first go through the insurance company limitations. This will differ from insurance company to insurance company. You will find with those top companies I mentioned earlier, you'll see right around, if you set the policies up properly, this 10% premium, 90% PUA. And again, I'm not going to mention any specific company there because they're all different. Some let you go a bit higher than that. Some are a bit lower. That's just a general average here for the sake of this discussion. But what this means, right? So if I tell you, okay, you can have a minimum 10% premium. Okay, like what's that mean in terms of me paying money into the policy? Well, if we take this example we have right here, and you pay in $1,000 towards the premium, that means you have the ability to pay up to $10,000 per year, meaning you can add another $9,000 into the PUA component. So I'm committing to the $1,000 and have the ability to go up to $9,000, which will accelerate my cash value to a much greater degree. So the first limit, the insurance company limit, however much I want the ability to add in, the premium must be 10%. So I cannot pay in $100,000 if I have a $500 minimum premium. I do have some limitations there. The second limit has to do with the IRS. So the term here that we want to be aware of is MEC, Modified Endowment Contract, is what this stands for. Now, again, a core benefit to a cash value life insurance policy is that if it's all set up properly, safe, liquid, tax-free. The tax-free component is what so many people are attracted to. If a policy becomes classified as this modified endowment contract, I have to deal with taxes. Very similar to that of a 401k, not in the sense that I can deduct payments. I cannot do that with a MEC, but more so that the money still grows tax deferred. However, when it comes to the gains, anything I access, I am liable to pay income tax on the gains, in addition to a potential 10% penalty tax that exists, that 10% penalty tax, if I am under the age of 59 and a half. So this ruins everything. The question is, how do I get rid of it? How do I make sure it does not occur so I can reap all of the benefits of a cash value life insurance policy? Quick side note, with a modified endowment contract, the death benefit is still paid out income tax free because it is still a life insurance policy. But how I prevent a MEC from occurring, which will ruin a lot of the benefits to the cash value component, is every policy has what is called a MEC limit, which is exactly what it sounds like. It is a limit that determines the maximum amount of money I can pay into a policy per year and still have the IRS consider it life insurance and not a pure taxable investment. So how we set that limit, a lot of people aren't aware of this. This is pretty neat, is we can set that limit wherever we want. And what you'll find is it has a direct relationship to my age and death benefit. Gender plays a role as well, but primarily age and death benefit on a life insurance policy will determine how much MEC space, call it my total MEC limit, what that figure is that I have the ability to pay into a policy. This is a technical piece. We don't have to know all of this. If you say, hey, just show me a max funded policy, yeah, we can definitely do that, or we design it for a lot of agents we work with and consumers that purchase policies through us as well. But if you like the details to understand how this should work, well, this is it. So this is really critical points, critical knowledge that I want to have if I'm a consumer, right? If I'm you, knowing this, at least the bullet points here, will give me enough information to know, okay, when I see a policy, I know that I can add more money in here. And if my goal is cash accumulation, well, I want to do that because this will give me greater cash value. So let's continue on here. So that's the cash value piece. Next, let's touch on flexibility. So if someone states, I want the ability to pay in $100,000 per year, but I don't want to get a bill for $100,000 per year. So I love the benefits of cash value life insurance. I want the ability to pay in this much, but I don't want it to feel like a burden and get this huge bill every year. Same thing if it's $1 million. So in the policy design here, we can set the premium, at approximately $10,000. The MEC limit at $100,000, maybe a little bit higher if you want to fund for a long time, we'll overinflate this. But what this allows me to do now is commit to approximately 10K. It'll fall between 10 and 12K most likely, because we have to attach what's called a term insurance rider to this policy to give me the ability to add more funds into it. But the main point here is I have a minimum commitment with the ability to add more money at leisure. Now all of a sudden, I've taken an insurance policy, which again, we think insurance, boring bill, pay the same amount, and we've shifted it into a flexible savings asset. I'm still committed to that minimum premium as long as I'm still funding it. However, I can make the excess payments at my discretion. It does depend on the company. All companies have different flexibility features. But let's look at this a little bit more to illustrate. Let's look at a visual. So on the left, you see the traditional policy we started with. That was the all base premium 100% insurance expense example. Then we see the max cash value policy. And again, same company, same product, different design, same individual health rating. Everything's consistent here, only we made some tweaks in the actual design of the product in order, call it to reverse engineer it and beef this up. So he's paying in $100,000 per year. Immediately, we see 88% of his payment show up in cash value, and he has a $4.25 million death benefit. Healthy policy in that respect. What's highlighted in yellow represents the break even. Cash on cash, call it, by year 4, I've paid in $400,000, I have $405,000. He funds it only for 10 years, and after this point in time, pays in nothing. So our annual outlay is 0. That means no premium, nothing. We shut the funding down earlier. This way, because he didn't want to pay anything else in, the cash value continues to grow with no out-of-pocket. Now, if he decides that he wants to continue to pay, you can easily design the policy to accommodate that. Now, on the design piece and flexibility, here's what we want to touch on. The premium in this example, just about 10%. That includes the minimum premium and that term rider we mentioned briefly earlier. So we can commit to approximately $10,000, just a touch higher, and then at discretion, add up to $100,000. On the right, this annual IRR. IRR represents internal rate of return. And annual only represents what he is earning year over year. So what is the cash value growing by each year? And why I emphasize that is if I look by year 4, I've paid in $400,000 and have a $5,000 gain. The annual IRR represents 2.94% that year. 3% on $400,000 is much more than 5K. So that would be the average IRR if we want to look at here. Here, the annual internal rate of return just represents each year what it's producing, tops out a little over 5%. And this is based off of a current projection. So one thing, whenever we look at projections, they're all well and good, but it's very good to look at the guarantees. It's also very good to look at actual performance, historical performance, what companies with different products have actually delivered as opposed to just projecting the best numbers. So we have more than a piece of paper then. So this talks about we just talked about designing a policy, how to set it up for maximum cash value, maximum flexibility. This, in my opinion, is one of the most important pieces, because if you've got this all set up, now you've got a policy that's maximized for cash value, very flexible, regardless of what I do, I've got a maximum policy here. Cash value, accumulating, a lot of options I have. Okay, so next we're going to look at using your policy. One thing to beef up the values, whole nother thing to actually use the money. So we talked about earlier, right? The core benefits of a life insurance policy are safe, liquid, tax-free. And then you've got that unique loan feature. So when we hear the word loan, typically what comes to mind? Payments and interest. Now, with life insurance policies, interest does accrue on policy loans. Payments are optional. Keep that in mind. We're going to do an example here. To start, however, a great way to illustrate how policy loans work is with real estate, since many are familiar with real estate. My artwork. Let's pretend that we have a home that no matter what happens in the economy, in the real estate market, my property every single year appreciates at 5% per year. Now, if you own that home free and clear, will the appraisal value of your property appreciate by 5%? Of course. If you have a loan outstanding, a mortgage or a line of credit, will you receive that 5% appreciation on the entire home or only the remaining equity? The entire home. Regardless, if we have a loan outstanding, so if we own it or if we have a loan, does not matter because that 5% will continue to occur on the entire property. The thing is, if I have a loan, interest at whatever interest rate it is goes to the lender, typically a bank. Now, how this works with a life insurance policy is as follows. So let's assume I have a policy with a dividend rate of 6%. Cash value, we'll assume, for simple numbers here, I have $100,000. And I elect to borrow out or loan $50,000. That means I have a $50,000 outstanding loan. There will be loan interest that is paid to the insurance company. Typically, you'll see loan interest rates with most companies fall between 5 and 6%. Now, it is possible to leverage a policy in the same manner that we can leverage real estate in the form of using it as a line of credit. And doing so often obtains much more attractive rates than we get on a basic insurance policy loan. But here's the thing. When I take a policy loan, if I don't take a loan, let's start there, I would receive a 6% dividend on my cash value. If I take a policy loan, what will happen here is I have the cost to borrow that goes to the insurance company, but I have that 6% dividend that's paid to my cash value and on the outstanding loan balance, meaning I continue to yield dividends and interest, the guaranteed rate and the surplus, if you go back to that section, or if you can recall that section, on my entire bucket of money as if I never touched it in the first place. So the question we'll always get here is how? How on earth and why would an insurance company do this? Let's demonstrate. Visuals always help. Help me at least. So here, quick sample, how policy loans work. Now, on the left, we have an example of a 45-year-old male paying in $50,000 per year for 5 years. So this is a nice example to demonstrate how we can stop funding much, much earlier if we wanted to, or he can continue to pay into the policy if he wants. But you've got your $50K for 5 years. Your dividend column, you want to look at this on both examples as we progress through everything. Cash value, so going back to how to set it up, design properly, breaking even, really at year 3 in this example. Death benefit, kind of an oddball figure here, right? $1,050,000. Where we came up with that figure is that generated a MEC limit of $50,000. So we were designing it really for the minimum death benefit based off of his payment. So that's the growth example, all well and good. How do policy loans work? That's the question here. How can I use the money? So, one, with policy loans, let's touch on a couple of bullet points here. I can take a loan anytime, and I have complete control. Loans are typically, as I take them, not reportable as income tax. It is a private contract. The life insurance policy does not impact my credit. Nothing like that shows up. I have the word loan in there, really, because a policy loan, I've got tax benefits there. If the policy is not a MEC. If it's a MEC, different story. I will have to deal with taxes. So I take out a $200,000 loan. My question is, what is the impact of that policy loan? Cash value reduces. View the cash value really as, call it your equity that you have access to. Whatever is in cash value, that's the gauge that determines how much I can access, what is it growing by. It's important to be aware of that. So that's the gauge that determines how much I can pull. But then I've got the death benefit here. Look what happens here. And compare it to the example on the left. What do you notice? Dollar for dollar reduction. In the example where I let it sit and grow, I had that $1,050,000. And then in this example, I borrowed out $200,000. I see my death benefit reduced by $200,000. So back to the question, how and why do insurance companies still pay me dividends and interest on my entire bucket of money as if I never touched it in the first place? Well, how is really they collateralize the death benefit. Remember, as an insurance company, a life insurance company, their first and foremost obligation is to do what? Pay life insurance claims. If I die with a loan outstanding on my policy, they are in the hook for that much less. So one way is that they collateralize the death benefit. The other way is that I have the cost to borrow, the interest. In this example, we had a 5% loan interest rate. I borrowed out $200,000. Here's my loan repayments. I can pay it back however I want. I do not have to set up a payment plan or anything like that. A lot of flexibility. But we pay back $50,000 per year plus approximately another $29,000. I paid back, call it $229,000. That was interest that went to the insurance company. If I stop there, one would make the argument, you pay interest on your own money. And you could make that argument because I'm borrowing from money I've built up, I'm paying it back, and there's an interest rate associated with it. If I stop there, this would make 0 sense. However, it's true, just like you pay interest on equity you borrow against on your home, you pay it to the lender, but if the home continues to appreciate, or I can generate cash flow to a greater degree, I'm okay with it. When I pay that loan back, look at my cash value and death benefit and compare it to the example where I just let it sit and grow. And what do you notice? Cash value and death benefit is 100% restored to exactly what it would have been as if I never touched it in the first place. Another way to put it is that there is no lost opportunity cost here. So a lot of times what individuals will do, this is really popular among real estate investors, where instead of just banking money in cash or purchasing more property by leveraging what they have in real estate and the equity with other property, they look at this and say, okay, I can pay money into this, always have access to it, and when an opportunity arises, I know if I pull my money out, I'm going to continue to yield the same dividends and interest regardless, and then I can acquire that property. So now I've got my policy working at work for me and also my real estate investments. And I can do the same thing with my business, paying off debt. There's a lot of good we can do with it. It's always good to look at the pros and cons. Here I'm talking about the pros and benefits. There's always drawbacks of any strategy, obviously, like the first couple years got a negative hit. But this is a nice example of how policy loans work. Now, let's touch on one more thing here. How else can we use it? A couple ways. Retirement income. So life insurance for a long time has really been used as a means to generate income on a tax-free basis. So again, if I don't trigger that modified endowment contract, if I don't lapse a policy with a gain on it, or do anything else that would trigger a taxable event, I can access that money on a tax-free basis. A lot of people will pull income out of these products in this manner. I have a death benefit. Great for legacy planning because death benefits are paid out income tax-free. Great for income protection. Maybe I've got these great plans. I take out this giant policy because I'm going to stuff it full of money for cash value benefits and purposes, and then I die. Well, now a death benefit is left to my beneficiaries. Business planning and corporations. This is interesting. We've got this term down here, executive benefits, because anyone can do this to a degree. Small businesses can do it. Some families will kind of practice the same thing. When you look at how many corporations use cash value life insurance, let's just demonstrate role play real quickly here. Let's say that I own a company and you are my employee. So you're working for me and you're making, say it's $100,000 per year, whatever the amount is. And I say to you, Joe, we're going to take out a life insurance policy on you. So you may have to go through underwriting, blood and urine, you've got to sign some paperwork, potentially. I'm going to take this life insurance policy out on you and I'm going to pay it. I'm going to own it. I'm going to be the beneficiary. If anything happens to you, the death benefits are paid to my company. So how do you feel right now, Joe? I'm taking this life insurance policy out on you, paying for it, but if anything happens to you, I cash in. What's the catch? Well, the catch is you, Joe, I'll say to you, if you stay with the company, if you stay with me for 10 years, maybe it's 20 years, let's say age 65 until you retire, if you don't leave me, I'm going to pay you a retirement benefit, income during retirement. Call it a pension that we create internally with the company. I know the word pension is not compliant, but we're going to use that for this example. So if you stay with me, you receive that benefit. Now, what I'm going to do is I've built that policy up over time by funding it. And as the owner, I had access to that cash value all the way through. I can use it to invest in my business, financing, whatever it might be, clear off debt. But at retirement now, I want to make sure I've got enough cash value in here to satisfy the promise I made to you. You retired. Thank you for your years of service. I'm going to pay you a retirement benefit, which I'm going to pull from the cash values of that policy so it does not impact my death benefit, my balance sheet or my income coming in from a company. And that's how I'm going to pay you that income, that retirement benefit. And then eventually, if and when you kick the bucket, we'll always ensure that a death benefit's intact to flow back to the company and recover the costs. So a lot of corporations will do that. Oh, by the way, the catch is if you ever leave, then you do not get that retirement benefit. Company retains the cash and can keep it, can elect to transfer the policy to another executive. A lot of professional sports teams do that kind of stuff actually, which is interesting. But it's interesting where corporations do this, big corporations and such, but you don't have to be a big corporation. We've done it for small businesses. Partners do that sometimes. A lot of good you can do. So one other thing we wanted to touch on here, kind of a neat, oh, I didn't know I could do that. You ever like when you see that stuff? I do. Is in respect to lump sum payments. So a lot of times people are attracted to a cash value life insurance policy, but they are not attracted to the idea of having to make payments for the rest of their life. So you can actually set up a policy where if we have a lump sum of money, we can move it into the policy over a short period of time. So here's someone with $1 million that we move into a policy over 4 years. Yellow represents the break even. You do have that initial hit. That is the drawback there. Death benefit, $7 million. The purpose of that gave him a MEC limit of $250,000 per year. Annual internal rate of return, funding it, nothing after year 4. Cash value continues to grow. The death benefit drops. We didn't touch on this in any of the other examples. After year 7, that has to do with that MEC law. So another name for our MEC limit or MEC test is the 7-pay test. Has to do with the first 7 years of a life insurance policy, or call it the vice grips from the IRS, are very tight on life insurance policies. After that, we can drop the death benefit and not have to worry about a taxable event. And cash value continues to grow. One last thing we want to touch on, because we get this question quite a bit. What if I'm too old? Or what if I'm older? Is that going to impact things? So here we've got examples of a 60 and 65-year-old, kind of a lump sum scenario. They only want to fund it for 5 years. The 60-year-old, let's look at the 65-year-old, 100 in, break even, year 4. Let's look at a 70 and 75-year-old. 75-year-old, break even, year 5. The thing is, when it comes to age on a life insurance policy, the older we grow, the more expensive life insurance is. Naturally, yes. However, you can reverse engineer a policy. And what I mean when I say that is if we are purchasing it where death benefit's important, but cash accumulation is the goal, we hear that quite a bit. I don't care about the death benefit. A lot of times people will say that is, okay, well, regardless if I'm 32 or if I'm 75 years old, if I'm paying $100,000 per year into a policy, and we go back to the design fundamentals, premium, PUA component, MEC limit, we can minimize the premium, maximize the cash value, break-even point for a 75-year-old male, year 5. The difference an older individual will see is a lower initial death benefit. We are reducing it as much as possible. If the 32-year-old male put in $100,000 per year, he'd have about 1.5, actually about 2 million plus in death benefit for the same $100,000 per year policy, if that makes sense. So, I know we covered quite a bit here. Hope you enjoyed this presentation. Reach out anytime you like, and we'll talk to you soon. Thanks again. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.